Real-World Financial Statement Analysis Final Project by Avante Dabney for BUS627 Financial Statement Analysis. Professor Michael Powers. Reviewing Target's revenue trends, we're able to see that overall sales have been on a steady incline each quarter, reporting a 4% increase from May to August from the horizontal analysis of the income statements. Per the accounting policy section of the notes to consolidated financial statement section, Target uses the same accounting policies when preparing quarterly and annual financial statements. They advise that due to the seasonal nature of our business, quarterly revenues, expenses, earnings, and cash flows are not necessarily indicative of the results that may be expected for the full year. Target also mentions that because they operate as a single segment, majority of the revenue and long-term assets are generated and located in the United States only. Reviewing Target's financial health, I'm able to reflect on the primary revenue and primary expenses for the company. Total sales can be segmented into 6 different sectors, including apparel and accessories, beauty and household essentials, food and beverage, hardiness, home furnishings and decor, and other. Of these 6 sectors, beauty and household essentials contribute $6.364 million or 27%, and apparel and accessories $4.269 million or 18% as the primary and secondary revenue in quarter 2. These figures were $6.726 million or 27% and $4.751 million or 19% in Q3 respectively. Sources of revenue are important to determine how a company will and should expect to make sales. However, allocation of expenses is equally important to examine how effective a company is being with its resources. Target's primary source of expenses is from cost of sales, which was $16.719 million in May and $17.28 million in August, and accounts for all expenses associated with sales and our primary revenue drivers. Secondary expense activities are selling, general, and administrative expenses, which were $4.509 million in May and $4.849 million in August. Completing a ratio review of liquidity, solvency, and profitability for Target, I was able to deduce the following. Target has been operating around a current ratio of about 1.5 to 1 for the last few quarters. Generally, the rule of thumb is 2 to 1 to reflect financial health. However, the lower ratio does not mean that they will fail. It's just that Target is not very liquid. Liquidity is important to ensure repayment of debt, and from May to August, the current ratio decreases from 1.7 to 1.4, while the inventory increased by 6.8%. Target's quick ratio was 0.42 in May and 0.38 in August, which is relatively low. For many companies, an asset test ratio below 1 is not desirable because it may signal the need to liquidate marketable securities to pay bills, regardless of the current trading price of the securities. However, in this case, Target does not have any marketable securities they would be able to liquidate, making them weak in cash. Although liquidity relates to the firm's ability to pay next year's debts as they come due, solvency concerns the ability of the firm to stay financially healthy over the period of time that existing debt is outstanding. Reviewing solvency ratios, Target saw minimal changes in debt to equity ratios over each quarter, from 3.37 to 3.46 respectively. Times interest earned decreased from 25.16 to 23.79, and debt service coverage increased from 13.64 to 23.18. Target has ample earnings to cover its interest for both quarters, and the debt service coverage ratio indicates that Target is in a healthy position to repay any interest and maturing principals. Profitability ratios allow financial analysts to see a company's ability to make payments towards interest and principals, but also how well they are using their resources to earn a larger return on investment. Target's gross profit ratio remained roughly 30% for both quarters. There was a decrease in profit margin from 9% to 7% in August. And finally, price earnings ratio reflects an increase from 52.71 to 62.54 for both quarters. In conclusion, reviewing the horizontal and vertical analysis of the income statements, balance sheets, and statement of cash flows for Target, I was able to determine that while the company is low on liquidity and solvency is looking relatively healthy, profitability has been steady, almost to the point of stagnation for the company over the last few quarters. Overall, I would say that the standing of the company is healthy. They've experienced positive revenue trends. They have been effectively managing their debt and overall are in a healthy financial position.